Okay, folks, good morning and welcome to Swing Trading Today. This is Bob Desmond, and it is November the 5th, 5 a.m. Eastern Standard Time. What we're going to talk about today is what is stagflation and how times in the past where we've seen stagflation, how they correlate to today and the economic environment that we find ourselves in now, and how we have a Federal Reserve who, in their own very words last week, gave the green light for inflation to run rampant at a very low and declining GDP growth. So let's go to the very definition, and then we'll swing back and we'll go over the pre-market activity, and we'll talk about a trade that we did yesterday to the short side, our first one in a while to the short side. Good morning, everybody out there. I'm going to drop a note in the chat box. Good morning. Let's make sure that's working. We are live on the Twitter, Facebook. Good morning. Okay, what is stagflation? And the reason why we're going to talk about stagflation is because it's really what our thesis is based upon right now for the core positions that we find ourselves in, which is gold, actually the gold miners, not necessarily gold, and silver. And what, for the most part, I'm trying to find a good chart here. You can see how ready I was for this commentary. What, for the most part, it is that we have stagnant growth, which we find ourselves in right now. They talk about 3% in the greatest economy ever, yet GDP can't trade above 2%. The target is 3%. They can't get anywhere near that. And you can see that in the past, during this time frame of the late 70s, this is just after Nixon took us off the gold standard, you saw Federal Reserve monetization of the debt skyrocket, as did interest rates. Back here, which is where we went completely nuts. This is during the Jimmy Carter days, where we rallied on Fed funds increasing. And then finally, the Federal Reserve under Paul Volcker broke the back of inflation. Leading to the big bond rally that we've seen, that we currently enjoy right now, but unfortunately, which has allowed for us to go ever deeper into debt. And in the 1970s, which is the most recent experience that we've had with stagflation, we had high oil prices, high inflation, unemployment was very high. You're not hearing about that now because what the government has done is that they no longer use the same metric, the same measure for unemployment that they once did. They use what you call the U3 unemployment report out of the BLS, Bureau of Labor and Statistics. And what you want to take a look at is the U6 number. And that has, not inflation, unemployment roughly about double where it is at current. And when you take a look at charts such as, I warned about this the other day, light sweet crude, actually since it's right in front of us, I warned about home heating oil as well. Home heating oil beginning to shoot up. I mean, this is only a 4-hour chart, but it has to begin somewhere. And you can see on this 4-hour chart, we are at the very cusp, the apex of a major breakout here on home heating oil. The same holds true And I'll go back to why this is important in a moment. The same holds true for light sweet crude. Last week, we recaptured a key breakout point. This week, we did a retest of that point. We rallied off of it. So I think that we're probably going to move higher on crude oil prices. And this is inflation, folks. Look at gasoline. Again, weekly chart. We are breaking out on a weekly basis. This is going to crimp the consumer. And the consumer, unlike back in the 1970s, is debt-laden. So the bankruptcies that we're going to see once this economy slows down is going to be unbelievable. And look out for the banks because they're going to take it right on the chin. And, of course, we'll be there to bail them out yet again. Now, what's going to do well? What will do well? Back in the 1970s, during stagflation, again, high inflation, low growth, low GDP growth, gold. And gold has been on a tear. In recent weeks, it's been consolidating. Right now, this week, it's down on the week, but it's holding support. Now, I want to bring up a couple of comments because we don't have stagflation technically yet, but we're going to. I want to bring up a couple of comments or changes to the statement out of the Federal Reserve, which is going to, at some point in time, get picked up by the market. How we're ignoring this right now is beyond me, but so be it. That's why we're contrarians. Okay, so this is the change in Jay Powell's statement from last week. In fact, we cannot remember a time in the last 30 years when a Fed chairman has so clearly articulated such a strong desire for more inflation. That is not a quote from Jay Powell. The following are verbiage like this. Remember, they wordsmith the heck out of his statement. So every letter has to be put under a microscope. Really significant. Powell is not saying that they will allow a significant move up in inflation, but going one better by adding the word significant. So he was willing, and we've known this for a while, that they were going to allow inflation to run beyond the 2% metric, which was their target for many, many years now. But now they're saying really significant. They're going to let it run. And how for the life of me, inflation is good for the average consumer? I have no idea. Can somebody please answer that question? The destruction of the U.S. dollar, how is that good for the U.S. consumer? It's beyond me. The next word, persistent. Unlike the prior few Fed chairmen who claimed to be vigilant towards inflation, Powell is clearly telling us that he will not react to inflation that is not only well beyond a really significant leap from current levels, but a rate that lasts for a period. So it's got to be really significant, and it has to be lasting for a good amount of time, meaning he's going to let inflation gain a foothold. And once you let that genie out of the bottle, it's very, very difficult to put a genie back in the bottle because it has all the magic, it has all the tricks to deceive you and to allow its power to grow ever stronger. And good luck getting that genie out of the back in the bottle. And what is the only real tool at the Federal Reserve's disposal? I'll bring you back to the chart of the Fed funds rate going back to 1970s. Right here. We had to raise the Fed funds rate dramatically up to nearly 20% before inflation was finally brought under control. What more did our Fed chair change? The word, or the phrase I should say, even consider if inflation is not only a really significant increase from current levels and stays at such levels for a while, they will only consider raising rates to fight inflation. So there's no way that they are raising rates anytime soon. I have never seen a Fed chairman be this clear with regard to future rate moves, unless, of course, there is really significant and persistent inflation. All the while, that inflation will keep a cap on GDP growth, and there you have stagflation. And if they fail to act very quickly and very aggressively, and they allow stagflation to run rampant, well, then you are going to get hyperinflation, and you are talking a doomsday scenario for this economy. I don't even want to go into it right now. It's so dire. And this is all brought to you by the Keynesian economic theory. I'll leave that for you folks to review. Maybe one day we'll all go and take a look at it together. But basically, it's economic theory based upon ever-expanding debt. For all intents and purposes, it's what we use right now for our Fed policy. Let's get to the pre-market activity. But before we do that, please smash that like button, kill it, destroy it. If you're not currently subscribed to the channel and you miss me when I go live, get notified. Simply click the subscribe button and click that bell button, and there's a radio button within that bell button. When you click it, click the all, and you'll get notified of when I go live. And let's get to the pre-market activity. I'll come back to this. I really wasn't prepared all that well. Meaning the hyperinflation topic. Let's go to a 4-hour chart here. We're going to begin with the U.S. dollar. I know this is difficult for some of you. The feedback I've gotten is that this black background is not the favorite. So I may have to switch, I'll have to switch it up and get a white background. If you agree with that, please leave a comment below. Okay. So the U.S. dollar yesterday was on a tear. And you can see that I went over this with members last night, so I'm not going to repeat myself. We did so on Market Wrap, which comes out every Monday through Thursday. And you can see that we had a heck of a move higher. And when I was talking about the chart last night on a closing basis, we were bull flagging out. I was expecting to move higher. We got to move higher. Now we are rolling over. I believe that this is a short covering rally on the dollar. Again, members, go check out Market Wrap for my reason why I believe. It's a very short commentary, about 10 minutes long. The reason why I believe that this is a short covering rally on the U.S. dollar and why we'll be looking to bulk up on our gold mining trade later on in the week. So the dollar, good day yesterday. A flight to safety. It was a very strange day yesterday in that we had some negative news out of China regarding the trade deal. And both stocks. Hey, Trent, good morning. I'm not fussed. What does that mean? So we had the U.S. dollar rally along with stocks on news out of China, and gold, silver, they both pulled back. And it was very strange yesterday. So we'll see whether or not it continues this strange behavior of negative news for the stock market and strength in the U.S. dollar. Normally, you'd get a rally in both the dollar and gold on negative trade news coming out of China. Oh, okay, cool. Thanks, Trent. Taking a look at, we already went over crude oil. Let's take a look at gold. All right, so gold, 4-hour basis. I was hoping that we would hold this support level here. We did not. We broke down below it overnight. This bar here opened up only 15 minutes ago. We're trying to catch a bid. Does it hold? I don't know. I wouldn't be a buyer of gold until we recaptured the 1510 level because we have broken down below support. I'm very bullish on gold, but I'm not going to be a denier of the fact that we are seeing some weakness here. We don't speak our book here. And we'd like to see gold trade back above 1510 before we got bullish yet again and look to add or not add to our gold position. We don't own a gold position. We own a gold mining position. And before we look to go buying more gold miners, I want to see gold back above 1510. Taking a look at silver. Silver held its own yesterday. It was down, but if memory serves, we did not put in a new daily low. We're down again this morning here. The joy of being live. What the heck did I do with that symbol? There it is. Okay. All right, so silver's down slightly. It's not looking bad though. Unlike gold, I have to say that silver is holding up better than gold. We're basing along the 20-period moving average on a 4-hour basis. If you pull back, here's the chart. We'll drill back down. So silver is at current. This 4-hour bar breaking out on a 4-hour basis. Looking pretty good on silver. The same cannot be said for gold. All right, so silver looking stronger on a relative basis than gold. I want to check out the 10-year bond price. It took it on the chin yesterday. Closing down very similar to the price action we're seeing on gold in that we broke down below 4-hour support and we continue to move lower. They're trying to give it a bid right now. And it's really important for bonds to rally to keep a bid under gold. Let's change this. Remove. All right, so clearly no breakout here. Okay. Hey, Sam. Oh, the euro. Why did the euro settle off, do you think, Sam? You're the man on the street over in Europe. Let's check out that trade. Because we're not getting a lot of news on that trade here. I've looked. I would have thought the euro would have continued higher. Yep, you called it. Lower highs and lower lows on a 4-hour basis. Let's pull back here. You know, sometimes you can get too close to the fire when you use the intraday charts. So you need to pull back and not allow those intraday charts to skew your longer-term view of a trade. And so I'm pulling back now to a daily chart. Austerity. I know austerity was imposed upon the Greeks, but I know the Germans are traditionally austere, but even in France, etc. Okay. All right. So kind of a question mark here. It looks like we're settling into a trading range on Euro USD, but if we rally up and through this upper band of resistance, well then, obviously the dollar is going to be in free fall. And the dollar on a weekly basis, I discussed this with members last night. Go take a look at the weekly Stokes. They're trading down below the 50 mark, and typically rallies tend to fade. So I'm expecting weakness on the dollar on the back half of the week. So, Sam, you're saying there's no austerity in Italy, right? Usually it's the Nordic countries, the northern European countries that have that inbred austerity DNA. I think in the south of Europe, it's more of a laissez-faire type of attitude towards spending. And they probably live longer, too. All right, let's take a look at the S&P futures. Now, when I take a look at this chart, because we went short yesterday for a brief moment, we booked some profits, not on the S&P 500, which is what you're looking at now, but on the Russell, and I'll talk about that in a moment, using the TZA. And we have a new daily high, but you need to pull back here and take a look at this 4-hour chart. I mean, really, we're setting up for a pullback here in the back half of the week. I'm not saying that we can't press higher, in all probability that we will, but I think that we are going to set up for a pullback here, and a rather nasty one at that. So new daily high here. In all probability, they're going to press it higher. When you take a look at the Russell 2000, we got short of it yesterday for a scalp. We were trading above right here. We were trading above the third standard deviation Bollinger Band on a 4-hour basis. So we opened up a scalp using the TZA and booked some profits there. But I wouldn't be looking to short now. I mean, the risk reward was so positive when we opened up the trade that we're probably it was so favorable I could not do it. We don't have that same situation right now. I think that I'm seeing the word melt up here or melt down. I'm using the word melt up, and that's what we're doing right now on this market. And I would choose not to fight it because volumes are rising on a daily basis. So I don't want to fight the market and try to go shorting it and pretending that I'm smarter than the market, which I'm certainly not. The NASDAQ also continuing higher here, new daily highs, up over 1/3 of a percentage point. And again, volumes are picking up. We're closing out the day fairly strong, near the highs of the day. So why fight it? Let this market run. But at some point in time in the very near future, we're going to be looking to open up short trades as a swing trade, not necessarily as a scalp, which I rarely do. Now, taking a look at energy, folks, I'm coming back to nat gas and energy. We discussed it earlier in terms of inflation. Yeah, the PCE number, the inflation number coming out this week, unless they announced it yesterday. I haven't checked it out. But that's the Federal Reserve's own personal favorite number for inflation. And, of course, they back out food and energy because that's very convenient for them. And you can see inflation is just, energy is just simply on a tear. So it looks as though we may pause here on nat gas. What's that symbol, Sam? I'll leave off with it. Looks like we're going to stall out here above this third standard deviation Bollinger Band and get a pullback. I would not chase this symbol or this commodity at current. And I believe that is Let's take a look at some random commodity. I want to see how broad-based this is. Like lumber. Here, soybeans. I don't want to look at this. Look at how tight this Bollinger Band is on a 4-hour basis. This is really tight. Yeah, you can see you have soybeans breaking out. So you have energy breaking out to the upside. You have food. I mean, soybeans is such a critical element to our food supply. I can't tell you. So you have soybeans breaking out on a weekly basis. Corn, also a critical element. Not doing so well. It was very hot. Now it's pulling back. I want to take a look at one other. Copper. Yeah, you can see copper is also breaking out here. It has broken out. We've done a retest. Looks like copper is going to move higher. So I would be a buyer of copper. Lean hogs were on a tear. Now they're pulling back. So you're seeing a lot of activity to the upside. Look at this. Cattle futures, weekly chart. Probing the upper band of resistance. No breakout yet, but you are seeing higher lows. So no breakout, but you're seeing commodities really begin to form a consolidation and in some cases break out on a weekly basis, and that stokes the flames of inflation longer term. And with that, folks, I'm going to sign off for this morning. Everybody have a really great and profitable trading day, and I will talk to you soon. Be well.